So how much do you think you can generate from your portfolio? Is it 5, 6, 8%? Maybe double digit? Today we're going to look at high yield ETF on the US side. Dividend investors, bonjour, my name is Mike Giroux and I am the founder of Dividend Stocks Rock and I'm also a passionate investor. I have this YouTube channel to help you invest with more conviction so you can enjoy your retirement. Last week we have covered covered call ETF on the Canadian side, and today I wanted to talk about high yield ETF on the US one. Didn't want to go through all just covered calls, so I decided to pick one that is focused on dividend investing, another one on preferred share, and we're going to finish with probably one of the most interesting, most favorite, popular covered call ETF on the US side, offering a 11% yield, which is a lot. But is it worth it? We're going to take a look at it at the end of this video. But first, let's talk about PGX. We're talking about Invesco Preferred Share ETF, ticker, you guessed it, PGX. The yield is close to 6%, so 5.73. Investing mostly in preferred shares, which is interesting because it's completely different than the other type of investment we discuss usually on this channel. Most of the time we're talking about stocks. This time we're talking about preferred shares. Expense ratio at 0.51%. The duration of the preferred shares at 5.37 years. Why duration is important? Whenever you look at bonds or preferred shares, the longest the duration is, the more volatile the price will be when the interest rate goes up. So when you think about it, whenever interest rate goes up, preferred shares and bonds that are existing will likely go down in value. Why? Because they're offering a lower yield. So to balance it out, you need then to buy it at a cheaper price to get pretty much the same yield as it's offering today. If not, no investors would like to buy a preferred share or a bond, giving a 5% yield when now they can do the same thing with the same level of risk, but get 6 or 7% yield, right? So whenever interest rate goes up, if you have a very long duration, like 10 or 15 years, expect the stock price, the ETF price, to go down massively. Number of holdings, 295. So if you're thinking about recreating this ETF, well, you might as well just pick the ETF itself because it will be too much work and for nothing. This is usually what I suggest to investors, especially when they're looking for bonds or for preferred shares. There's like so many rules, so many things that you have to study, different types of preferred shares. Why don't you just leave that to professional? In terms of sector allocation, you will not be surprised. You're going to find a lot of financial, a lot of utilities, and a lot of REITs in this portfolio. Most of it has a very good credit rating, and I think it's very important, especially because you don't want necessarily to invest in poor stocks that may eventually go bankrupt, because then you would leave a lot of money on the table and lose a lot of your income for your retirement. When we consider how this one has performed over the past 10 years, well, obviously you cannot really compare it to the Vanguard Dividend Appreciation ETF because this one is really all about dividend growth. So it offers a lower yield but a larger total return. The comparison that White Chart suggested us is the Bloomberg US Aggregate, which is not exactly fair either because they're following bonds and not necessarily preferred shares. But overall, what you see here is for the total return, you got 51% over the past 10 years. It's not that much, to be honest. So you're basically getting the yield and that's pretty much it. So it is a good source of income for your portfolio, but don't expect anything else than that. You can see that starting in 2022, stock price, the ETF price dropped drastically. Why? I just told you before, whenever interest rate will go up, bonds and preferred shares will go down in value because the new preferred shares being issued right now are offering a better deal. So to make sure that everything balances out, you get to this point. So overall, for PGX, if you are looking for a source of stable income, this is exactly what it's going to do, but don't expect much total return out of it. However, if you're retired and you just want to balance your budget, this could be a pretty interesting solution. Now going with Global X Super Dividend, kind of crazy name, right? We get a yield around 5%, which is kind of interesting. Obviously, it goes after high income potential, about 50 holdings. So you could recreate this portfolio on your own. Mind you, 50 holdings is a little bit too much to my taste. I prefer to have a portfolio between 20 and 40 stocks. You get a monthly distribution, which is kind of very interesting. The yield is good and the expense ratio is pretty interesting as well at 0.45. Not too expensive to have it professionally managed. And obviously this ETF aims at a low volatility portfolio. So you're looking at a good source of income, monthly income could be good. Let's take a look now at the industry breakdown. And this is where I'm a bit surprised. We're talking about low volatility, but the largest sector is the energy sector. Would have expected a little bit more of utilities, consumer staples, or REITs, but now we're getting a little bit more energy. I mean, you know my point on energy, and yes, right now it's doing well, but it is very volatile. So if you're expecting to build a portfolio that will help you sleep well at night, having almost 20% of it in the energy sector, not completely convinced. However, it does show a lower beta ratio, which is interesting. And when you look at the top holdings, you don't have much concentration here. We're talking about the largest holdings are like 2%, between 2 and 2.5%. A lot of companies that I'm not necessarily in love with, companies like Iron Mountain, some REITs as well. Duke Energy could be probably my favorite one, the top 10, and Consolidated Edison. So those two would be pretty much my two favorite out of top 10. Not much to think about. Doesn't really fit the dividend growth investing strategy that I have at DSR. But now let's just take a look. We had a super dividend name. So let's see how it fares again. A dividend appreciation ETF. So surprise, surprise, not that well. So I decided to compare it to the total return and then to the Vanguard dividend appreciation ETF as well. So looking at the market, obviously the market did a lot better because it has some tech stocks and a little bit more growth stocks. This is why it has outperformed dividend growers over the past 10 years. But looking at the super dividend, remember with Invesco, we had roughly 50% return. Now we're down at 46, which is not that impressive, especially because you consider that you should be earning 5% yield. So in general, you're kind of like losing a little bit of capital just for the sake of income. Again, it's nice to get a 5% yield. On the other side, if it means that during a bull market of 10 years where the market doubled and then tripled, you're not even able to show a 4%, 4-5% annualized growth rate, maybe you're falling a little bit behind, especially when you consider inflation. Now your income is not increasing in terms of, well, when you consider total return, it's not increasing, not looking that great. Now, the moment that you have waited, we're going to look at the most popular, I guess, the largest, the most generous covered call ETF on the US side. But before that, I just want to let you know that I've done all that research using the new Dividend Stocks Rock ETF screener. We have over 600 ETF, both trading on Canadian and US side. If you're looking for high yield preferred bonds, dividend growers, but also Bitcoin, Ethereum, gold, utilities, financial, name it, we have all of them in the stock screener. You can search by MERs, by performance over the past 1, 3, and 5 years. You have all of that data included in your subscription. So you might as well want to take a look at Dividend Stocks Rock just to see if ETF could fit in your portfolio. Now, let's talk about the Global X Nasdaq 100 covered call ETF. I don't want to do a complete video on covered call, but I cannot ignore this one. We have 103 holdings, so pretty much the Nasdaq 100, you guessed it. Expense ratio at 0.60%, not that bad, but the yield, wow, yield, like trailing yield over the past 12 months is 13%. Right now we're getting about 11%, which is kind of incredible, right? So you invest your money and you get double-digit yield on it. that would fit pretty well with any kind of investors, right? So you put $500,000 in that, and then you're going to generate over $50,000 in income every single year. I think a lot of people would like to retire on that, right? So now let's take a look at the sector breakdown. Well, no surprise here, Apple, Microsoft, Amazon, largest holdings here. So not necessarily companies that are geared toward paying a dividend. As you can see, Alphabet, Meta, Platform, Tesla, even Nvidia doesn't even pay much in terms of percentage. So we're really talking about the Nasdaq. We're really talking about growth stocks here. But by writing covered call, you can generate a lot of income. However, don't expect the distribution to be equal. As you can see there, from April 2021 to March 2022, you see that there's some fluctuation, and then in December you got a very nice distribution over there. But over 12 months, you cannot really base your retirement budget on it, or even though it will generate some generous income. When you look at what happened over the past 9 years on this graph, you can see that again, the global X covered call is falling behind the Nasdaq, the S&P 500, falling again behind the dividend appreciation ETF. So again, in the sake of getting more yield, you have to fall back behind in terms of total return. Now there's one thing that you might want to consider when you're thinking about covered call is they will not likely perform well during a bull market, because every single time you will have stocks that will be options that will be exercised, meaning that you will be forced to sell a stock that is keep growing in value, and you are pretty much stuck to sell it at a kind of like a rebate. So you're making profit, but you're not capturing the full profit of that growth. On the other side, now that we are more into a recession mode, it will be interesting to see how those covered calls will react moving forward, because going forward, you should be able to just write down your options and not necessarily getting exercised, because the price will not go up. However, is the price of the option will be as generous as before? That's another story. So we'll see how it goes. Are you going to be able to generate that double-digit yield again with the Nasdaq covered call? In my opinion, is it worth it? Well, I don't think so, especially when you compare the huge difference. If the covered call ETF would have generated like 110 or 120%, I think it would have made sense to sacrifice a little bit of return to get a safer, stable income. In this case, we're not there yet. I think that you're leaving a lot of money on the table, especially on this one, where the market has actually did twice the performance of the covered call ETF. So we're not talking about a little bit of money on the table. We're talking about a ton of it. So I hope that you will consider this before making a decision. Obviously, if you just care about income, those are 3 very interesting picks that you can look at your portfolio. Again, not buy or sell recommendation or not financial advice, but I do hope that you have enjoyed this video. So you can give me a thumbs up and let me know in the comments, what is your favorite high yield ETF on the US side? Would like to know if I've missed any interesting one. I'm sure I did, because there are so many ones that I could have covered today. And until the next video, don't forget to stay invested.